Hi everyone, welcome to business. We're going to continue with the finance unit. So we've previously been looking at final accounts and a quick recap over your profit and loss accounts. Give you 2 seconds to have a little think about what the gross profit and net profit figures are that are missing from this table. Okay, time's up. So sales revenue minus cost of sales is gross profit. So that gives us 55,000 in the first year and 30,000 in the second. Net profit is gross profit minus expenses. So that gives us 15,000 and 18,000. Well, which one is better? And that's what we're going to think about today, because this becomes quite hard to measure given a variety of different sets of data. Again, we're going to explore this through profitability and ratio analysis. So this is where we're going to use the gross profit margin, the net profit margin, and the return on capital employed. So this session is going to focus on how to use them to calculate. And as we move forward, we'll look at strategies to improve them. Okay, so the main thing that we use this for is to assess the performance of a business. So we can do that in comparison to previous years or in comparison to a different business. So in this case, based on this information alone, which company do you think is doing better? Well, based on this information alone, then I'm going to say company A is doing better because they have a significantly higher amount of revenue. Okay, now a different set of data. We've got net profit for 2 companies. And in this case, I'm going to say again, company A is doing a lot better because they have a higher net profit. Now, things are a bit different because we have both sets of data for both companies together, and we can start looking at data in a different way when we've got 2 sets, because this is where we can do a comparison. Now, in this case, you might still say, well, company A is doing better because they're producing a higher amount of net profit. However, another way I might look at this is say, okay, well, which company has a higher proportion of their sales revenue becoming net profit? Well, in this case, company B has way over half of their sales revenue ending up as net profit, whereas company A, a much smaller amount of their sales revenue is net profit, which means a high proportion of that has gone on cost of sales and expenses. So having 2 sets of data is great because what it means is that we can compare different things, different sets of data to make comparisons in terms of performance. And in this case, we're going to look specifically at profitability. So ratio analysis is what we're looking at. It's a quantitative management tool for analysing and judging the financial performance of a business, and it can assess performance where current figures are compared with previous years or compared with rivals. So 3 ratios that we're going to look at today. We'll start with the gross profit margin. So on the right-hand side, you've got a very simplified profit and loss account for 2 different years for a case study business. So gross profit margin shows the amount of the sales revenue that then becomes gross profit, but it shows it as a percentage, and percentages are really good because it makes it really easy to compare one year to another, because we can't look at that 55 and that 30 in isolation because the sales revenue figure was different. So what we want is something nice and easy to compare, which is a percentage. Now the gross profit margin is calculated gross profit divided by sales revenue times by 100, and it's written as a percentage. And what we want is the gross profit margin to be nice and high. So the higher the gross profit margin, the better, because then more money is going towards paying for these expenses later on. Okay, so an example of how to work it out. I've already worked it out for 2018. So 55 divided by 90 times 100 is 61. When you write them down, you need to show all of your working like this, and you need to write the little percentage symbol. So just a little second for you to think about doing it for 2019. How would you work it out? Okay, correct. You would work it out. 30 divided by 70 times 100 is 43%. Okay, now we can see it was higher in 2018 than 2019. Okay, net profit margin. This takes into account all costs of sales and expenses, and we're looking at net profit compared to sales revenue. So it's calculated net profit divided by sales revenue times by 100. And this is a better measure of the firm's profitability as it accounts for both types of costs. And again, the higher the net profit margin figure, the better. So I've calculated it for 2018. 15 divided by 90 times 100 is 17%. Please can you work it out for 2019? Okay, again, correct, well done. It is 18 divided by 70 times 100 is 24. And you'll always write it out like this, showing you're working and writing a nice percentage sign at the end. Okay, now the final one, this is our efficiency ratio. And this looks at how well a firm's financial resources are being used. So this means, you know, all of the investment in the business into like, you know, machinery, even into like human resources, etc. How well has that been used to generate profit? So what we have is we have our capital employed, which is all of the investment into the business. So here you calculate the return on capital employed by the net profit before interest and tax divided by the capital employed times by 100. So the capital employed is your long-term loans, share capital and retained profit, which is found on the balance sheet. And the net profit is found on the profit and loss account. So for our return on capital employed, you do need to do a little bit more on this because you're going to look at two separate final accounts, and you have to do a bit of a calculation to work out the capital employed and put it into this formula. So I've calculated it for Wong's Wigs for 2018. So calculated capital employed, 2 plus 5 plus 3 is 10 to get my capital employed. The net profit is 15 divided by that 10 times by 100 is 150%. So show my working, and I've put a nice little percentage symbol on the end of this. Okay, now you work it out for 2019. Okay, well done again, and good showing of your working out. It is capital employed is 11, so 18 divided by 11 times 100 is 164%, and we can see the return on capital employed was higher in 2019. Okay, so this session was just about the calculations only. So to summarise, net profit margin compares net profit to revenue and is calculated net profit divided by revenue times 100. Gross profit compares gross profit to revenue and is calculated gross profit divided by revenue times 100. And return on capital employed compares net profit to capital employed and is calculated net profit divided by capital employed times 100. Capital employed is all the investment in the firm, share capital plus retained profit plus long-term loans. Okay, and that is how to calculate the profitability ratios, and I'll give you some examples to practice on the classroom. Okay, thank you. Bye.